It's one of the oldest and most corrosive feelings known to man. It's a quiet poison that starts in your gut and spreads to your mind, clouding judgment, rewriting your plans, and turning prudence into a liability. It's the feeling you get when you see your neighbor, your friend, your colleague, someone you know, someone you feel you're smarter than, suddenly strike it rich. They didn't build a business over 30 years. They didn't toil and save. They bought something you'd never heard of 6 months ago. A meme stock with a funny name, a cryptocurrency with a dog on it. And now, they're posting pictures of a new car, they're talking about quitting their job. They're looking at houses in a neighborhood you only dream of. And in that moment, all your discipline, all your careful planning, all your sensible long-term strategies suddenly feel not just slow, but stupid. That feeling, that gnawing, gut-wrenching envy, is what Warren Buffett considers to be one of the most powerful and destructive forces in the world of finance. It is the single greatest threat to your capital. It is the emotional siren song that has lured countless intelligent investors onto the rocks of financial ruin. This isn't about greed. Greed is simple. It's the desire for more. Envy is complex and far more dangerous. Envy is the feeling that someone else is getting more, and they don't deserve it, and you are being left behind. It transforms investing from a logical process of acquiring assets into a frantic emotional race you didn't even know you were running. It is the engine of every speculative bubble in human history, from the Dutch tulip mania in the 1630s to the dot-com bubble of the late 1990s to the crypto and meme stock manias we see today. The story is always the same. A new asset, a paradigm-shifting technology, a story that is easy to understand and exciting to tell. Early adopters make fortunes. Their stories spread like wildfire, amplified by the media and now, by social media. The narrative shifts from "this is a good investment" to "you are a fool if you're not in on this." And that's when the envy kicks in. That's when the fear of missing out, the infamous FOMO, becomes unbearable. It's at that exact moment, when the price is highest, when the risk is astronomical, that the average person, driven by the sight of their neighbor's new Tesla, finally throws in the towel, abandons their strategy, and buys in at the absolute peak. They are not buying an asset. They are buying a lottery ticket to escape the pain of being left behind. And in doing so, they become the exit liquidity for the early investors. They are left holding the bag. The financial transformation we are going to architect today is the construction of a powerful mental shield against this destructive emotion. It is about forging a mindset of such profound internal focus that the financial successes of others, especially the spectacular speculative ones, become completely irrelevant to your own journey. We will deconstruct the mental trick that Warren Buffett has used for over 70 years to insulate his capital and his mind from the madness of crowds. This is not about a stock market tip. It is about a fundamental rewiring of your investor psychology. We will build, from the ground up, a system of rational investing based on his principles, a framework that will not only protect your money from market hype, but will empower you to build lasting wealth with a sense of calm and clarity. This is the path to true financial discipline, the kind that allows you to execute your plan, year after year, decade after decade, until you achieve the financial freedom you deserve. We will accomplish this by exploring 5 foundational pillars, each a chapter in the manual of emotional fortitude. We begin with the most important rule of all: playing your own game. The first pillar in building our defense against the poison of envy is perhaps the most famous of all of Buffett's principles, yet it is also the most profoundly misunderstood. It is the concept of the circle of competence. At its surface, it sounds simple: stick to what you know. But its true power lies not in what it tells you to do, but in what it gives you the strength to not do. It is the ultimate permission slip to ignore the party happening next door, because you understand with absolute certainty that it's not a party you're qualified to attend. The greatest test of this principle in Buffett's career, and the most visceral illustration of its connection to envy, came at the apex of the greatest speculative mania of the 20th century, the dot-com bubble. To understand the pressure Buffett was under, you have to transport yourself back to the late 1990s. The world was changing at lightning speed. The internet was no longer a novelty, it was the future. Companies with names like GeoCities, Pets.com, and Webvan were appearing out of nowhere and achieving billion-dollar valuations overnight, often with no profits, no clear business model, and sometimes no revenue. It was a gold rush, and the financial media was its biggest cheerleader. Every day, the talking heads on television would ridicule the old guard, the so-called dinosaur investors, who just didn't get it. And the chief dinosaur, the prime target of their mockery, was Warren Buffett. His company, Berkshire Hathaway, was dramatically underperforming the market. While the Nasdaq was rocketing up 85% in 1999 alone, Berkshire Hathaway actually lost 20% of its value. Imagine that. The greatest investor in history was losing money, while teenagers in their basements were becoming millionaires day trading internet stocks. The letters he received were brutal. Shareholders, friends, and critics all asked the same question. Had the old man lost his touch? The peak of this pressure cooker environment came in July of 1999 at the annual Sun Valley Conference, an exclusive retreat for the titans of media and technology. It was a gathering of the new gods of the digital age. All around Buffett were the architects of the new economy, people like Bill Gates of Microsoft and Andy Grove of Intel. These weren't just his peers, they were his friends. He was sitting at the epicenter of the revolution, and he was the only one not buying a ticket for the ride. The envy was palpable. It wasn't just about seeing a neighbor get rich. It was about seeing the entire world get rich on a phenomenon he was publicly abstaining from. He was asked to give a speech, and the entire room was waiting to hear him either capitulate and admit he was wrong, or justify his seemingly archaic position. What he did next became the stuff of legend. He didn't talk about stock charts or price-to-earnings ratios. He delivered a master class on business history and human psychology. He methodically went through the history of other transformative industries, automobiles and aviation. He pointed out that at the dawn of the 20th century, there were over 2,000 car companies in the United States. An investor knew, with absolute certainty, that the automobile would change the world. But how could you possibly know which of those 2,000 companies would be the winners? How could you pick Ford and General Motors out of a field of thousands of eventual bankruptcies? The same was true for aviation. The industry was a game-changer for humanity, but for most of its history, it had been a capital-destroying nightmare for investors. His point was devastatingly simple and powerful. It is not enough to know that a new technology will be revolutionary. As an investor, your job is to know with a high degree of certainty how the economics of a specific business will look in 5, 10, or 20 years. And when it came to these new internet companies, he admitted with complete humility that he had no idea. He couldn't tell the winners from the losers. He couldn't project their cash flows. He couldn't value them with any confidence. They were, for him, simply outside his circle of competence. He said the most important thing in investing is not how much you know, but how realistically you define what you don't know. He concluded by warning that the speculative frenzy, detached from business fundamentals, would end badly. He was openly choosing to look foolish in the short term to avoid being wiped out in the long term. He was choosing to endure the pain of envy to preserve his capital. Less than 9 months later, the Nasdaq bubble burst. It collapsed by nearly 80%, wiping out an estimated $5 trillion in market value. The high-flying dot-coms vanished. The day-trading millionaires were wiped out. And Berkshire Hathaway? Its stock soared as investors fled the wreckage and sought refuge in the real, profitable, understandable businesses he had patiently held all along. He hadn't just avoided the crash. He had defined the very essence of how to protect yourself from the hype that fuels it. The psychological principle underpinning the circle of competence is a direct countermeasure to one of the most pervasive cognitive biases that makes us vulnerable to envy, the Dunning-Kruger effect. This is a well-documented phenomenon where people with low ability at a task overestimate their ability. In essence, they are too incompetent to recognize their own incompetence. When a new and exciting investment class emerges, like crypto or meme stocks, the initial narrative is always simplified. You hear buzzwords: decentralized finance, the metaverse, short squeeze, and after watching a few YouTube videos or reading a few Reddit threads, a dangerous illusion of knowledge begins to form. You start to feel like you get it. This is the peak of Mount Stupid on the Dunning-Kruger graph, where a little bit of knowledge leads to a massive spike in confidence. Envy acts as a powerful accelerant to this process. When you see your neighbor making money, your brain desperately wants to believe that you can too. It short-circuits the intellectual humility required to say, "I don't truly understand the underlying technology, the competitive landscape, or the long-term cash-generating potential of this asset." Instead, envy whispers a different story. "It can't be that hard if that guy is figuring it out. He's not smarter than me. I can do this." This is the Dunning-Kruger effect in action, supercharged by social pressure. You mistake familiarity with a topic for genuine expertise. You know the names of a few cryptocurrencies, so you feel you understand blockchain technology. You've heard the term gamma squeeze, so you feel you're equipped for the complex world of options trading. This illusion of competence makes you feel justified in abandoning your own proven strategy to jump into a game you don't understand, with rules you can't see, against opponents who have been playing it for years. The circle of competence is the antidote. It is a forced, rational act of self-assessment. It demands that you confront the brutal reality of your own ignorance. It replaces the arrogant confidence of the novice with the cautious humility of the professional, which is the only mindset that can protect you from the siren call of easy money. True investor psychology isn't about being the smartest person in the room. It's about knowing exactly where the boundaries of your own intelligence lie and having the discipline never to step outside them, no matter how great the temptation. So how do we translate this powerful psychological principle into a practical, repeatable mental model? The blueprint for applying the circle of competence is an exercise I call the 3 circles audit. It's a simple, tangible process you can do with a pen and paper that will serve as your definitive map for all future investment decisions. First, draw a large circle on a piece of paper. This is your entire investment universe. Now, inside that large circle, draw a smaller, concentric circle. And finally, inside that one, draw a small circle in the very center. You should now have 3 rings, like a target. The innermost circle is your circle of deep expertise. Inside this circle, you will write down the industries, businesses, or assets that you understand with the proficiency of a professional. This is not about what you've heard of. It's about what you could teach a college-level class on. Perhaps you've worked as a software engineer for 20 years. Enterprise software companies might be in this circle. Maybe you're a doctor, and you understand the intricacies of medical device companies and pharmaceutical trials. Maybe you've run a successful retail business for a decade, and you deeply understand consumer brands, supply chains, and inventory management. For most people, this circle will be very, very small. It might even be empty at first, and that is perfectly okay. Honesty here is paramount. The second middle circle is your circle of working knowledge. Here, you list the areas where you are not a world-class expert, but you have a solid, functional understanding. You know the key players, the business models, and the competitive dynamics. You could hold an intelligent conversation with an industry professional and ask the right questions. For example, you might not be a banker, but you understand how banks make money from net interest margins, and you know how to read their financial statements. You might not be a logistics expert, but you understand the business of railroad companies or package delivery services. This circle will be larger than the first, but it still requires genuine, hard-won knowledge. The third, outermost circle represents everything else. This is the circle of ignorance. Inside this massive space lies biotechnology if you're an accountant, complex derivatives if you're a dentist, cryptocurrency mining operations if you're a lawyer. It contains every investment, every asset class, every company that you do not understand at a deep fundamental level. Now here is the rule, the core of the mental model. You are only allowed to invest in companies that fall within your inner circle, the circle of deep expertise. You are allowed to spend time researching and learning about things in your middle circle, with the goal of eventually moving them into the center. But you are forbidden, absolutely forbidden, from ever putting a single dollar into an asset that resides in your outermost circle, the circle of ignorance. This map becomes your filter. When the next hot meme stock comes along, you pull out your map. Is it in your inner circle? No. The decision is made, you ignore it. When your neighbor tells you about a new altcoin that's guaranteed to go to the moon, you check the map. Is it in your inner circle? No. You wish them well and move on. This process drains the emotion out of the decision. It replaces envy and FOMO with a simple binary logical test. It is the practical application of Buffett's wisdom, a personal blueprint for rational investing that keeps you firmly planted in your own game, immune to the hype destroying the portfolios of those who wander into territories they don't understand. To fully grasp the power of this model, we must dedicate ourselves to studying its opposite, the path of the 99%. The antithesis of the circle of competence is not just ignorance, it's the arrogant pursuit of opportunity without knowledge, fueled directly by envy. The cautionary tale is the archetypal dot-com day trader of the late 1990s, a story that has been replayed with frightening precision by the meme stock and crypto traders of today. Let's create a composite character. We'll call him Gary. Gary is a successful dentist. He's smart, he's built a good practice, and he has a healthy income. He invests his savings responsibly in a diversified portfolio of mutual funds. It's a sensible, proven strategy for wealth management. But it's slow. Then, the dot-com boom happens. His brother-in-law, who knows nothing about business, makes $50,000 in 3 months on a company called eToys. His hygienist is paying for a vacation with her profits from Qualcomm. Gary starts watching CNBC during his lunch break. He opens an E-Trade account. He tells himself he's just playing around with a small amount of money. He makes his first trade in a company he'd heard about called CMGI. It goes up 15% in a week. The feeling is intoxicating. It's a rush of adrenaline and validation that his slow, boring mutual funds could never provide. This early success is the most dangerous thing that can happen, as it reinforces the Dunning-Kruger effect. He thinks, "This is easy. I have a knack for this." He starts spending his evenings on Raging Bull and Silicon Investor message boards, the Reddit of his day, reading due diligence from anonymous posters with names like TechGuru99. He's not analyzing balance sheets. He's consuming narratives, hype, and social proof. He sees everyone else is buying, so he buys too. His definition of a good company becomes a stock that is going up. He sells his boring, profitable blue-chip stocks to fund his new obsession. Soon, he's using margin, leverage. He wants to accelerate his gains to catch up with the people who got in earlier. He is no longer a dentist who invests. He is an investor who happens to practice dentistry. His entire emotional state is now tied to the daily flickers of the NASDAQ ticker. He's completely abandoned his own circle of competence, dentistry and small business management, and is now playing in the most speculative corner of the financial world, a game he does not understand. When the bubble inevitably pops, it happens fast. The margin calls come, the forced liquidations begin. In the space of 6 months, Gary doesn't just lose his profits. He loses his entire initial capital and ends up owing money to his broker. He is financially and emotionally shattered. The path of the 99% is paved with the wreckage of people who let the envy of others, easy money, lure them out of their own area of expertise. They mistake a bull market for genius and learn the devastating difference when the tide goes out. This is not a failure of intelligence. It is a failure of emotional discipline and a direct consequence of ignoring the boundaries of one's own competence. The direct financial connection between adhering to the circle of competence and building real lasting wealth is stark and quantifiable. It boils down to one of the most important concepts in all of finance: the avoidance of catastrophic loss. The mathematics of compounding are overwhelmingly tilted in favor of consistency over short-term high-risk gains. Let's look at the balance sheets. Imagine two investors, Investor A and Investor B, who both start with $100,000 in 1998. Investor A is our Buffett disciple. She defines her circle of competence, which includes consumer goods and insurance. She buys shares in Coca-Cola and Berkshire Hathaway. Her portfolio is boring. Investor B is our dentist, Gary. He gets swept up in the dot-com mania. He sells his boring stocks and puts his $100,000 into a hot internet company. Let's use a real one, Pets.com. In 1999, Investor B has a fantastic year. Pets.com is a media darling. Its stock is soaring. His portfolio value might double to $200,000. He feels like a genius. Meanwhile, Investor A's portfolio plods along. Maybe it's up 10% to $110,000. She looks and feels like a fool compared to Investor B. He is living the dream she is missing. Then comes the crash of 2000-2001. Pets.com, a company that was famously losing money on every bag of dog food it sold, goes bankrupt. Its stock goes to zero. Investor B's portfolio is wiped out. His $100,000 is gone forever. He is out of the game. Investor A's portfolio might dip a little in the recession, but Coca-Cola is still selling soda, and Berkshire's insurance companies are still collecting premiums. Her portfolio weathers the storm. By 2002, she is back on her steady compounding trajectory. Fast forward 20 years. Investor A's initial $100,000, compounding at a steady, reasonable rate, has grown into a substantial sum, providing her with true financial freedom. Investor B's portfolio value is still zero. He had to start over from scratch. This is the critical lesson. In the game of wealth management, avoiding the one decision that can take you to zero is infinitely more important than capturing the one that promises a 10x return. A single catastrophic loss inside the circle of ignorance can negate decades of patient, disciplined saving and investing. When you operate within your circle of competence, you are not just buying businesses you understand. You are buying a form of insurance against your own worst emotional impulses. Your knowledge acts as a firewall, protecting your capital from the flames of speculative manias. It ensures that you stay in the game, allowing the mathematical miracle of compounding to work its magic over the long term. That is how this principle manifests on your personal balance sheet, not as a single spectacular entry, but as the quiet, relentless upward march of your net worth, year after year, shielded from the envy-driven disasters that periodically decimate the portfolios of the 99%. The second pillar of our mental fortress against envy is the cultivation of what Buffett calls an inner scorecard. This is a profound shift in perspective. It's the decision to measure your success and make your decisions based on your own internal metrics and standards, rather than by the applause, criticism, or, most relevant to our discussion, the perceived success of the outside world. Living by an inner scorecard means you are running your own race, on your own track, for your own prize. Envy, by its very nature, is the purest expression of living by an outer scorecard. It is the act of constantly looking over at someone else's track, comparing their lap time to yours and feeling inadequate. Developing an inner scorecard is the only way to find immunity. The most powerful anecdote for this comes from the very foundation of Buffett's empire, the early Buffett partnership letters. From 1957 to 1969, before Berkshire Hathaway became his primary vehicle, Buffett ran a small investment partnership for a handful of family and friends in Omaha. Each year, he would write a detailed letter to his partners, explaining his investment philosophy, his recent decisions, and his performance. These letters are now legendary, a masterclass in clear thinking and rational investing. But what is most striking about them is Buffett's relentless focus on his own scorecard. From the very beginning, he set the terms of his evaluation. He told his partners that his goal was not to beat the market every single year. He made it explicitly clear that in roaring bull markets, the kind of go-go years where speculation ran rampant, they would almost certainly underperform the Dow Jones Industrial Average. His conservative, value-based approach of buying wonderful businesses at fair prices simply couldn't keep up with the speculative fervor. However, he made them a promise. His true goal was to protect their capital and achieve a better-than-average return over a full market cycle, bull and bear combined. His specific benchmark was to beat the Dow by an average of 10 percentage points per year over the long haul. Think about the psychological discipline this required. In years like 1961, when the Dow was up 22%, Buffett's partnership was up a staggering 46%. He was a hero. But in a frothy year like 1968, the Dow was up almost 8%. But Buffett, unable to find anything cheap to buy, returned 59%. He was a genius. But what if the situation were reversed? Imagine a year when the market was up 30% and he was only up 15%. By the standards of Wall Street, by the outer scorecard, he would have been seen as a failure. His neighbors, invested in the hot mutual funds of the day, would be getting richer, faster. The temptation to abandon his principles, to chase performance, to buy riskier assets just to keep up appearances, would have been immense. But Buffett had pre-committed, both to his partners and to himself, to his own set of metrics. His inner scorecard was clear. Did I adhere to my process? Did I act with rationality and discipline? Am I protecting our capital from permanent loss? Am I on track to meet my long-term goal? By focusing on these questions, the short-term noise of the market and the envy-inducing gains of others became irrelevant. He was playing a different game. And his results speak for themselves. Over the life of the partnership, he never had a down year, and he compounded his partners' money at nearly 30% annually, crushing the Dow and laying the financial foundation for what would become Berkshire Hathaway. He proved that the ultimate source of investment success comes not from seeking external validation, but from rigorously adhering to an internal standard of excellence. The psychological principle that the inner scorecard is designed to combat is one of the most powerful forces in human nature, the principle of social proof, also known as herd mentality. Humans are social creatures. For millennia, our survival depended on our ability to stick with the tribe. If everyone in your tribe suddenly started running, you didn't stop to analyze the situation, you ran too. Assuming the herd knows something you don't is a deeply ingrained evolutionary instinct. In the modern world of investing, this instinct is constantly hijacked. When we see a large number of people, our friends, our colleagues, the talking heads on TV, the anonymous accounts on social media, all doing the same thing, like piling into meme stocks or crypto, our brain's ancient wiring screams at us to conform. We experience a powerful cognitive bias where we assume that the actions of others reflect the correct behavior for a given situation. This was famously demonstrated in the Asch conformity experiments in the 1950s. In these studies, a subject was placed in a room with a group of actors and asked to perform a simple visual perception task. The actors would all intentionally give the same, obviously incorrect answer. A shocking number of subjects, despite knowing the correct answer, would go against the evidence of their own eyes and conform with the group's wrong answer, simply to avoid the discomfort of being the lone dissenter. Envy is social proof on steroids. It doesn't just create a desire to conform, it adds a painful emotional cost to nonconformity. Not only do you feel the anxiety of going against the crowd, but you also have to endure the agony of watching them be rewarded for it, at least in the short term. This combination is almost unbearable for most people. It's what causes a rational, long-term investor to abandon a perfectly sound strategy and buy a wildly overvalued asset at its peak. They are not making a financial decision, they are making an emotional one, seeking to alleviate the psychological pain of being left out. The inner scorecard is a conscious act of rebellion against this instinct. It is the deliberate choice to trust your own analysis over the behavior of the herd. It's the courage to be the one person in Ash's experiment who stands up and says no. The answer is A, even when everyone else is shouting B. This emotional independence is not a natural state. It is a learned skill, a form of mental conditioning that is absolutely essential for any serious pursuit of wealth management. To build this skill, we need a practical mental model, a tool that can serve as our North Star when the winds of social proof and envy begin to blow. The most effective tool for this is the creation of a personal investment policy statement, or IPS. This might sound like something only for large institutions, but creating a simplified version for yourself is one of the most powerful acts of financial discipline you can undertake. An IPS is a formal document that you write for yourself, by yourself. It is the constitution of your financial life. It's the physical manifestation of your inner scorecard. It consists of several key sections. First, the statement of purpose. Here you write down in clear and emotional language what your money is for. It's not just to get rich. It's to achieve financial freedom by age 55, so I can travel the world with my spouse and not be a burden on my children. It's to build enough capital to start my own business in 10 years. This purpose becomes your anchor. Second, investment objectives. This section quantifies your goals. You define your target rate of return. Is it to beat inflation by 5%? Is it to achieve an average annual return of 8%? This must be a realistic long-term number, not a lottery ticket dream. Third, and perhaps most importantly, risk tolerance. Here, you must be brutally honest with yourself. How much of a portfolio decline can you stomach before you panic and sell? 20%? 30%? 40%? You should write down a sentence like, I understand that in pursuit of my long-term goals, my portfolio may experience temporary declines of up to 35%, and I commit to not selling based on fear during these periods. Fourth, strategy and asset allocation. Define your approach. Are you a dividend growth investor, a value investor, a passive index fund investor? What is your target mix of stocks, bonds, and other assets? Be specific. For example, my portfolio will consist of 60% in a low-cost S&P 500 index fund, 20% in an international index fund, and 20% in a total bond market fund. Finally, rules and constraints. This is where you lay down the law for yourself. Write down rules like, I will not invest in any individual company outside my circle of competence. I will never use leverage or margin. I will rebalance my portfolio once a year on my birthday. I will not check my portfolio value more than once a week. Once you have written this document, you print it out, sign it, and put it somewhere you can see it. This IPS is now your boss. It is your inner scorecard, codified. When envy strikes and you're tempted to buy that hot crypto your friend is bragging about, you are forced to consult the document. Does this align with my stated purpose? Does it fit my strategy? Does it violate one of my rules? The answer will almost always be a clear and resounding no. It externalizes your discipline, creating a barrier between your emotional impulses and your investment capital. It is the ultimate blueprint for rational investing, a personalized system for making decisions based on your own goals, not the noise of the crowd. The antithesis of the inner scorecard is the investor whose entire sense of self is tethered to the minute-by-minute fluctuations of the market and the opinions of others. This is the modern retail investor, chained to their smartphone, endlessly scrolling through financial news, social media, and their brokerage app. Let's call her Chloe. Chloe has a good job and has saved up a decent nest egg. She wants to grow her wealth, but she has no defined philosophy. Her scorecard is entirely external. Her measure of success is simple. Is my account balance green today? Am I beating the S&P 500 this week? Am I doing better than the posters on r/Wall Street Bets? Her day starts with checking her portfolio before she even gets out of bed. The pre-market futures dictate her mood for the entire morning. She sees a stock on her watch list is up 8% on some vague rumor, and the FOMO is instantaneous and overwhelming. She sells a solid, dividend-paying company she has owned for years, a company she ostensibly bought for the long term, to chase the momentum. She justifies it by saying, "I can't miss out on this run." Her social media feeds are a constant source of envy and anxiety. She sees someone post a screenshot of a 1,000% gain on an options trade and feels a pang of inadequacy. Why isn't that me? What am I doing wrong? She joins a Discord server where everyone is hyping up a new altcoin. The social proof is immense. Hundreds of people are confirming each other's biases, creating an echo chamber of extreme conviction. The idea of not participating feels like a personal failure. So she buys in, not because she's read the white paper or understands the technology, but because she can't stand the thought of being the only one on the sidelines if it moons. Chloe's portfolio is a chaotic mess, a reflection of her emotional state. It's a collection of last month's hot trends and this week's momentum plays. She has no strategy, only a series of reactions to external stimuli. She is constantly churning her account, racking up trading fees and, more importantly, short-term capital gains taxes, which act as a massive drag on her performance. She is living the definition of a life governed by an outer scorecard, and the inevitable result is a portfolio built on a foundation of sand, destined to be washed away in the next market storm. Her quest for quick riches driven by envy ensures she will likely never achieve lasting wealth. The direct financial connection of adopting an inner scorecard is one of the most underappreciated forces in personal finance. The dramatic reduction of frictional costs and the maximization of long-term compounding. Every time an investor like Chloe, driven by envy and FOMO, makes a trade, she incurs costs. Some are explicit, like trading commissions or fees. But the most significant costs are implicit and far more damaging. The first is taxes. In the United States, investments held for less than a year are taxed at the short-term capital gains rate, which is the same as your ordinary income tax rate, often 24%, 32%, or even higher. Investments held for more than a year are taxed at the much lower long-term capital gains rate, which is often 15% or 20%. Let's quantify this. If you are in the 24% tax bracket and make a $10,000 profit on a stock you held for 11 months, you will owe $2,400 in taxes. If you had just waited one more month, you would owe only $1,500. The outer scorecard, which demands constant action, costs you an extra $900 on that single trade. Now, multiply that over a lifetime of investing. The investor with an inner scorecard, guided by their IPS, makes very few decisions. They buy and hold quality assets for years, even decades. The majority of their gains are taxed at the preferential long-term rate. The high-turnover, envy-driven trader is giving up a massive chunk of their profits to the government every single year. The second major cost is opportunity cost. When Chloe sold her solid dividend-paying company to chase a meme stock, she didn't just sell a stock. She sold a piece of a compounding machine. That boring company might have gone on to raise its dividend for the next 20 years, with its share price steadily appreciating. The meme stock she bought likely crashed back to earth. The long-term difference is not just the loss she took on the fad, but the massive future gains she forfeited from the quality asset she sold. Let's chart it out. A portfolio that earns 10% per year but has a 2% annual drag from taxes and trading fees due to high turnover will be worth almost 40% less after 30 years than a portfolio that earns the same 10% but is managed with a buy-and-hold strategy. 40%. That is the quantifiable balance sheet impact of an inner scorecard. It's not a fuzzy, feel-good concept. It is a mathematical advantage that translates into hundreds of thousands or even millions of dollars over an investing lifetime. It is the financial discipline to let your assets compound with minimal interference, shielded from the envy that compels others to constantly interrupt that powerful process. Our third pillar in this mental fortress is a powerful mental model that fundamentally reframes your relationship with the market itself. It is the allegory of Mr. Market, a concept Benjamin Graham introduced and Buffett has championed for his entire career. This model teaches you to see the market not as a wise, all-knowing entity that sets the correct price for assets, but as a manic-depressive business partner. Envy and FOMO derive their power from the belief that the market knows best. When a stock is rocketing up, we believe the market is telling us it's a great business, and we should get in. The Mr. Market allegory shatters this illusion and replaces it with a framework for profitable, rational action. The story that best illustrates Buffett's mastery of this concept is his legendary investment in American Express during the salad oil scandal of 1963. In the early 1960s, a small, unassuming company in New Jersey called Allied Crude Vegetable Oil Refining Corporation was running one of the biggest frauds in financial history. They were borrowing massive amounts of money from banks, including a subsidiary of American Express, using their inventory of salad oil as collateral. The scam was brilliant in its simplicity. They would fill their giant storage tanks mostly with water, with only a thin layer of oil floating on top. When inspectors came, they saw what they expected to see. The company was essentially borrowing against phantom assets. In November of 1963, the fraud was exposed, and Allied Crude promptly filed for bankruptcy, owing its creditors what would be over $1 billion in today's money. Wall Street panicked. The perception was that American Express, through its warehousing subsidiary, was on the hook for all the fraudulent loans. This was an existential threat. The market's reaction was swift and brutal. Mr. Market went from manic to deeply suicidally depressive about American Express. The stock, a blue-chip darling, collapsed by nearly 50% in a matter of weeks. The consensus on Wall Street, the outer scorecard, was that the company was doomed. This was a classic case of herd mentality, driven by fear. This is where Warren Buffett, a young, little-known fund manager from Omaha, saw not a crisis, but an opportunity. Instead of listening to Mr. Market's screams of terror, he decided to do his own research. He treated Mr. Market not as a source of information, but as a source of offers. Mr. Market was standing at his door, weeping, offering to sell him shares in a great franchise at a ridiculously low price. Buffett's job was to determine if the fear was justified. So he hit the pavement. He went to banks, restaurants, and travel agencies in Omaha. He talked to merchants and customers. He asked them a simple question. Were they going to stop using American Express travelers' checks or credit cards because of a scandal at a warehousing subsidiary? The answer was a resounding no. They didn't care about the salad oil. They cared about the brand, the trust, the global acceptance. Buffett realized that the company's core business, its competitive advantage, was completely unharmed. The market, in its panic, was confusing a temporary, manageable loss at a subsidiary with a mortal wound to the parent company. He concluded that the intrinsic value of American Express was far, far higher than its current stock price. So he acted with conviction. He invested 40% of his entire partnership's capital into American Express stock. It was the single largest investment he had ever made. Over the next few years, as the company sorted out its legal issues and the market's fear subsided, the stock price soared, making an enormous fortune for Buffett and his partners. He hadn't predicted the future. He had simply recognized that his business partner, Mr. Market, was in a temporary fit of depression and was offering him a bargain. This mindset is the ultimate weapon against market hype and envy. The underlying psychological principles that Mr. Market helps us overcome are emotional contagion and the availability heuristic. Emotional contagion is the phenomenon where we catch feelings from others, just like a virus. When the market is in a state of panic, the fear is broadcast through every financial news channel and social media feed. We see charts dripping in red, we hear terrifying headlines, and we feel the anxiety of other investors. Our brains are not wired to distinguish between a threat to our physical safety and a threat to our portfolio. The fear feels real and urgent, and it compels us to act, usually to sell at the worst possible time. The reverse is true during a bubble. The greed and euphoria are also contagious. We see stories of instant millionaires, and we catch their excitement, leading us to buy with reckless abandon. The availability heuristic is a cognitive shortcut where our minds judge the likelihood of an event based on how easily we can recall examples of it. The stories of people getting rich on Dogecoin or GameStop are vivid, exciting, and widely publicized. They are readily available in our memory. This makes the probability of that outcome seem much higher than it actually is. We forget about the thousands of failed cryptocurrencies and the millions of retail investors who lost money on meme stocks because their stories are not as memorable or exciting. Envy is the amplifier for both of these biases. The vivid, available story of your neighbor's crypto windfall makes the emotion of greed highly contagious. You don't want to miss out on what feels like a common, easily achievable outcome. The Mr. Market allegory provides the psychological distance needed to break this cycle. By personifying the market as a separate, emotionally unstable entity, you can observe its moods without catching them. You can say, Mr. Market is euphoric today. His offers are probably not very good. Or, Mr. Market is terrified. I should see if he is offering me any bargains out of his panic. This reframing creates a cognitive buffer, allowing your rational mind to stay in control, insulating you from the contagious emotions and biased narratives that lead the majority of investors astray. To put this into practice, we can develop a specific, actionable mental model, the Mr. Market checklist. This is a short list of questions you must ask yourself before making any investment decision, especially one triggered by a major market move. It forces you to adopt the mindset of a rational business owner, not a reactive speculator. The checklist has 4 questions. Question 1. What is Mr. Market's prevailing mood today? Take a moment to diagnose him. Is he manic and euphoric, screaming about a new paradigm where prices can only go up? Or is he depressive and panicked, convinced the world is ending and everything is worthless? Simply identifying his emotional state is the first step to detaching from it. Question 2. Is the price he is offering me based on long-term business fundamentals or short-term emotion? Look at the asset in question. Is the price being driven by years of growing earnings and a strong competitive position? Or is it being driven by a Reddit thread, a celebrity tweet, or a wave of panic selling? This question forces you to separate the signal of a company's intrinsic value from the noise of market sentiment. Question 3. Am I feeling Mr. Market's emotion, or am I thinking like a business owner? This is a crucial moment of self-reflection. Be honest. Is your heart pounding with greed because the price is skyrocketing? Is your stomach churning with fear because it's collapsing? Acknowledge the feeling, and then consciously set it aside. Ask yourself, if I were the sole owner of this entire business, would today's news fundamentally change my view of its long-term prospects? This shifts your perspective from that of a stock renter to a business owner. Question 4. If I had the cash, would I be willing to buy the entire company at this price? This is the ultimate test. It's easy to buy 100 shares of a company. It's much harder to stomach the idea of buying the whole thing. If a company has a market capitalization of $1 billion, you must ask, would I write a check for $1 billion for this entire enterprise? This forces you to think about the valuation in absolute terms, not just relative to its recent price action. If the answer is a clear yes, you may have found a bargain. If the answer is no, then you have no business buying even a single share. Using this 4-question checklist consistently will build a powerful habit of rational, detached analysis. It will become your shield, deflecting the emotional arrows of greed and fear that Mr. Market constantly fires at you, allowing you to operate with the calm, opportunistic mindset that is the hallmark of a true CEO mindset in investing. The antithesis of the Mr. Market mindset is the investor who sees the market as an infallible oracle. They believe the market is always right, and therefore its mood is a direct reflection of reality. This is the path of the 99%, and it leads to the predictable and disastrous behavior of buying high and selling low. The quintessential example is the investor who panicked during the 2008 global financial crisis. Let's call him David. David was a diligent saver. He had built a portfolio of high-quality companies and index funds. He understood the businesses he owned. But in the fall of 2008, the world seemed to be ending. Lehman Brothers collapsed. AIG was bailed out. The stock market was in a freefall. David turned on the television, and every report was of financial Armageddon. His friends were losing their jobs. His portfolio was down 40%. The emotional contagion was overwhelming. David didn't see a manic-depressive business partner offering him a bargain. He saw an all-knowing God named the market, telling him, with absolute authority, that his investments were worthless and were going to zero. He mistook Mr. Market's temporary panic for a permanent verdict on the future of capitalism. The fear became so unbearable that he couldn't sleep. He finally capitulated. Sometime in late 2008 or early 2009, near the absolute bottom of the market, he called his broker and said, "Sell everything. I can't take it anymore." He sold his shares in world-class companies at prices that were, in hindsight, the bargain of a lifetime. He moved his money to cash, locking in a massive, permanent loss of capital. Of course, the world didn't end. The government intervened, the economy slowly recovered, and the stock market began one of the greatest bull runs in history. But David missed it. He was too traumatized to get back in. He watched from the sidelines as the market doubled, then tripled from its lows. His mistake wasn't in owning bad assets. His mistake was in believing that Mr. Market's mood was a fact, rather than an opinion. He let the market's temporary depression dictate his long-term financial destiny, a classic failure of risk management that stemmed from his inability to separate his own analysis from the contagious emotions of the crowd. The direct financial connection of mastering the Mr. Market allegory is the ability to generate superior returns through the principle of margin of safety. This is the cornerstone of value investing and the mathematical engine of Buffett's success. Margin of safety is the difference between the intrinsic value of a business and the price at which you can buy it in the market. A rational investor insists on always having a significant margin of safety. For example, if you analyze a business and calculate conservatively that it is worth $100 per share, you don't buy it at $95. That leaves no room for error. You wait until Mr. Market, in one of his depressive fits, offers it to you for $50 or $60 per share. That discount, that $40 or $50 gap, is your margin of safety. This has two profound financial benefits. First, it provides massive upside potential. When Mr. Market eventually sobers up and realizes the business is worth $100, your return is not just a few percentage points, it's a double. You make your money not when you sell but when you buy. You are locking in future profits by capitalizing on current pessimism. Second, and just as important, it provides downside protection. If you were wrong in your analysis, and the business is only worth $70 per share, you still make a profit buying at $50. If some unforeseen event happens and the value drops to $40, your loss is minimal. However, the investor who bought at $95 with no margin of safety is facing a catastrophic loss in the same scenario. Capitalizing on Mr. Market's moods is the only reliable way to purchase assets with a significant margin of safety. These opportunities simply do not exist when the market is euphoric and prices are high. They only appear during times of broad market panic or industry-specific pessimism. By training yourself to be greedy when others are fearful, you are giving yourself a structural, mathematical advantage over other market participants. This isn't about market timing, it's about price discipline. On your personal balance sheet, this manifests as a portfolio that not only generates higher long-term returns, but also exhibits lower volatility and risk. It's the tangible financial reward for cultivating the emotional fortitude to smile when your business partner is panicking and offer to buy what he is so desperate to sell. This brings us to our fourth pillar, a concept that acts as a dangerous accelerant to all the other emotional mistakes: the poison of leverage. Leverage, in simple terms, is using borrowed money to invest. It's the financial tool that can turn a bad decision, driven by envy, into a life-altering catastrophe. Envy makes people impatient. They don't just want to get rich. They want to get rich now, to catch up with their neighbor who seems to be on a faster track. Leverage appears to be the magic button that can make that happen. It amplifies gains, but it also amplifies losses, and most critically, it introduces the risk of total ruin. The most terrifying and instructive story about the dangers of leverage, a story that Buffett himself was called in to help clean up, is the spectacular collapse of long-term capital management in 1998. LTCM was not a fund run by amateurs. It was a dream team of financial superstars. Its partners included John Meriwether, the legendary head of bond trading at Salomon Brothers, and two Nobel Prize-winning economists, Myron Scholes and Robert C. Merton, the intellectual architects of the modern options pricing model. These were, by any objective measure, some of the smartest people in finance. Their strategy was to use complex computer models to find tiny, temporary pricing discrepancies in global bond markets, and make thousands of trades to profit from them. The individual profits were minuscule, so to generate impressive returns they needed to use an astronomical amount of leverage. For every $1 of their own capital, they were borrowing and trading with over $25. At its peak, the fund had about $5 billion in capital, but controlled over $125 billion in assets, and had off-balance sheet derivative positions with a notional value of over $1 trillion. For a few years it worked like magic. They generated returns of over 40% annually. They were the new kings of the universe, and the envy of the financial world. They believed their models had essentially solved the problem of risk. They were smarter than the market. But in 1998, the unthinkable happened. Russia defaulted on its domestic debt, and a subsequent flight to safety caused market correlations to behave in ways their models had not predicted. Their supposedly risk-free trades started generating massive losses. And here is the deadly sting of leverage. When you own an asset outright and its price falls, you can hold on and wait for it to recover. But when you've bought it with borrowed money, your lenders don't care about your long-term thesis. They want their money back, now. LTCM was hit with a tidal wave of margin calls. They were forced to liquidate their positions at the worst possible time, into a panicked market, which only drove prices lower and exacerbated their losses. In the space of a few weeks, the fund lost over $4.6 billion, 90% of its capital, and was on the brink of a default that threatened to trigger a chain reaction and take down the entire global financial system. The Federal Reserve had to orchestrate a massive $3.6 billion bailout from a consortium of Wall Street banks, a consortium that included Warren Buffett's Berkshire Hathaway. The smartest men in the room, driven by the desire to generate spectacular returns, were wiped out by the one thing their models couldn't account for: the brutal, unforgiving mathematics of leverage. The psychological biases that make leverage so tempting are overconfidence bias and the gambler's fallacy, both supercharged by the social pressure of envy. Overconfidence bias is the tendency for people to be more certain of their own abilities than is objectively reasonable. After an investor makes a few successful trades, their brain is flooded with dopamine. They start to feel invincible. They attribute their success to their own unique genius, rather than to luck or a bull market. This overconfidence makes them believe they can handle more risk. Leverage no longer seems like a dangerous gamble. It looks like a smart, logical tool to accelerate their inevitable journey to wealth. They think, "I'm on a hot streak. I can't lose. I should press my bets." This is often coupled with the gambler's fallacy, the mistaken belief that if something happens more frequently than normal during a given period, it will happen less frequently in the future, or vice versa. In investing, this often manifests after a few losses. A trader using leverage might think, "I've had 3 losing trades in a row. The next one is due to be a winner." This faulty logic encourages them to double down, to add more leverage, precisely when their strategy is not working. Envy pours gasoline on this fire. When you see others making leveraged bets and posting massive gains, your own overconfidence is validated. You feel pressure to keep up. The idea of just using your own capital seems slow and foolish. You feel that using leverage is the only way to get on their level. This cocktail of overconfidence, faulty logic, and social pressure creates a feedback loop that leads investors to take on more and more risk, right up until the moment the market delivers a dose of reality and the risk of ruin becomes a certainty. Financial discipline means recognizing these biases in yourself and treating leverage with the extreme caution it deserves. The applied mental model to protect yourself from this danger is a two-part process: a personal leverage audit and the establishment of zero-tolerance rules. The first step, the audit, is about creating a crystal-clear picture of all the leverage in your financial life, both explicit and implicit. On a sheet of paper, list every single dollar you owe to someone else. This includes your mortgage, car loans, student loans, and credit card debt. Then, look at your investment accounts. Do you have a margin account enabled? Have you ever traded options, which have implicit leverage? Do you own any leveraged ETFs? The goal is to see, in black and white, your total exposure to borrowed money. Many people are shocked to find how much leverage they are already using in their daily lives, without even considering its impact on their overall financial risk profile. The second step is to establish a set of hard, unbreakable, zero-tolerance rules for the use of leverage in your investment portfolio. For 99% of retail investors, the best rule is the simplest. I will never use borrowed money to buy publicly traded securities, period. This means you do not enable margin on your brokerage account. You do not trade complex options strategies that can result in losses greater than your initial investment. You do not buy leveraged ETFs that promise 2x or 3x the daily return of an index. This simple, hard and fast rule eliminates the possibility of a single investment decision wiping out your entire net worth. For more sophisticated entrepreneurs or real estate investors, the rules might be more nuanced, but they must be equally strict. For example, I will only use non-recourse debt for real estate where the property itself is the only collateral and my personal assets are not at risk. Or, for my business, I will maintain a debt-to-equity ratio of no more than 0.5. The key is to define your rules in advance, during a moment of calm rationality, so that you are bound by them during moments of emotional temptation. This framework is a critical component of risk management. It is a pre-commitment to financial sobriety, ensuring that the intoxicating allure of getting rich faster with borrowed money can never lead you to the poorhouse. The antithesis of this disciplined approach is on full display every day in the world of modern retail trading. The path of the 99% is exemplified by the young trader, let's call him Alex, who discovers the world of meme stocks and options trading through platforms like Robinhood. Alex is smart and tech-savvy, but his financial education comes from TikTok and Reddit. He sees a post about a company called GameStop. A community of online investors is trying to engineer a quote-quote squeeze. The story is compelling, a David versus Goliath narrative. The FOMO is intense. He opens his trading app and buys a few shares with his own money. The stock doubles in a day. The rush is incredible, but his gains feel small compared to the screenshots he sees online. People are posting 6- and 7-figure gains. He realizes they are not just buying stock, they are buying call options. A call option gives you the right to buy a stock at a certain price, and it costs a fraction of the stock itself. It's a highly leveraged bet. Alex decides to get in on the action. He sells his stock and uses all the proceeds to buy out-of-the-money weekly call options. He is no longer investing in a business. He is making a highly leveraged, timed bet that the stock's price will go up dramatically within a few days. For a moment, it works. The stock continues to scream higher, and the value of his options explodes. His account value multiplies by a factor of 10. He feels like a financial god. This is the peak of overconfidence. But then, the momentum shifts. The stock begins to fall, just as quickly as it rose. The value of his options evaporates. Because options have an expiration date, He can't just hold on and wait. In the space of 48 hours, his 10x gain turns into a 100% loss. His entire investment is gone. But it gets worse. In his excitement, he had also started trading on margin, borrowing money from his broker to make even bigger bets. Now, not only is his investment wiped out, but he owes his broker money. A margin call forces him to sell other assets or deposit more cash, which he doesn't have. 1 week of envy-driven, leveraged gambling has not just reset his financial progress to zero, it has put him in the negative. This story, in various forms, has played out hundreds of thousands of times, a direct consequence of combining a powerful emotional trigger like envy with a financial weapon of mass destruction like leverage. The direct financial connection between avoiding leverage and long-term wealth is rooted in the brutal, unforgiving asymmetry of returns. This is a mathematical reality that every investor must internalize. If you lose 50% of your capital, it takes a 100% gain to get back to where you started. Let that sink in. A 50% loss requires a 100% gain just to break even. If you lose 90% of your capital, a very real possibility with leveraged bets, you need a 900% gain to recover. The financial hole gets exponentially deeper the more you lose. Leverage dramatically increases your exposure to these large, mathematically devastating losses. A 10% decline in an asset you own outright is a manageable setback. A 10% decline in an asset you bought with 10-to-1 leverage wipes you out completely. You are at zero. And once you hit zero, the game is over. The magic of compounding is gone forever, because you have no capital left to compound. On your personal balance sheet, avoiding leverage is the ultimate act of capital preservation. It ensures that you can never be forced out of the game by a margin call or a forced liquidation. It guarantees that you will survive the inevitable market downturns with your capital base intact, ready to take advantage of the opportunities that panic creates. Buffett has often said that the rules of investing are simple. Rule number 1, never lose money. Rule number 2, never forget rule number 1. He is not talking about never having a stock go down in price. He is talking about avoiding the permanent loss of capital. And the easiest and most common way investors suffer a permanent loss of capital is by using leverage, getting caught in a downturn, and being forced to sell at the bottom. By staying away from borrowed money in your portfolio, you are ensuring that your financial journey is a one-way street. It might have bumps and detours, but there is no cliff you can be pushed off of. This commitment to always being able to play tomorrow is the bedrock of any sound wealth management strategy, and the ultimate financial benefit of conquering the temptation of leverage. Finally, we arrive at our fifth and final pillar, the great anchor that holds our entire mental fortress in place, the embrace of the long game. This principle is the ultimate antidote to the short-term, feverish emotion of envy. Envy is a disease of impatience. It is born from the desire to have what someone else has, right now. A genuine, deeply held commitment to a long time horizon drains this urgency of its power. When your goal is not to get rich this month or this year, but to build lasting financial security over the next several decades, the frantic race to keep up with your neighbor's speculative wins becomes utterly absurd. The perfect illustration of Buffett's commitment to the long game is his 1972 purchase of See's Candies. In the early 1970s, See's Candies was a well-regarded but seemingly unremarkable family-owned chocolate company based in California. It wasn't a high-growth technology company. It wasn't a hot stock. By all external measures, it was a boring old-economy business. Buffett and his partner, Charlie Munger, were presented with the opportunity to buy the entire company for $25 million. Their initial analysis suggested it was overpriced based on its tangible assets like factories and inventory. Many conventional value investors would have passed. But Buffett and Munger saw something deeper. They saw a brand with a fanatical following. They saw a product that people bought for emotional reasons, birthdays, holidays, apologies, which gave the company immense pricing power. They realized they weren't just buying buildings and equipment. They were buying a durable competitive advantage, a moat around their business that resided in the minds of their customers. They bought the company, and in the years that followed they did not engage in any brilliant financial engineering. They simply ran the business well and, year after year, raised the price of their chocolates a little bit, which customers happily paid. This small, boring decision created an ever-growing stream of cash. That initial $25 million investment has since generated over $2 billion in pre-tax earnings for Berkshire Hathaway, cash that was then reinvested into other wonderful businesses. Most investors in 1972, driven by envy of the hot Nifty 50 growth stocks of that era, would have seen See's Candies as a slow, stodgy, and unimpressive use of capital. They would have been chasing the quick, exciting pop, not the slow, steady drip of cash from a chocolate company. But Buffett was playing a different game. He was playing the long game. He had the patience and the foresight to buy a wonderful business and just let it work its magic over decades. See's Candies became the prototype for the kind of business Berkshire would go on to own, and it stands as the ultimate testament to the immense power of a long-term perspective, the perfect counter-narrative to the get-rich-quick mentality that envy fosters. The psychological bias that a long-term mindset directly counters is called hyperbolic discounting. This is our brain's powerful, innate tendency to prefer smaller, immediate rewards over larger, later rewards. Our brains are not naturally wired for long-term thinking. An ancient human who found a fruit tree was better off eating all the fruit now, rather than planning for the distant future. This instinct is still with us. A slice of chocolate cake right now feels much more compelling to our brain than the abstract goal of being healthier in a year. In finance, hyperbolic discounting is what makes speculative gambling so alluring. The prospect of a 50% gain in a meme stock this week delivers a much more powerful emotional jolt than the mathematical certainty of a well-funded retirement in 30 years. Envy weaponizes this bias. When you see someone else experience a sudden, immediate reward, your own brain's hyperbolic discounting goes into overdrive. The easy money they just made feels intensely real and desirable, while your own long-term plan suddenly feels frustratingly slow and abstract. You start to discount the value of your large future reward because the pain of missing out on the small, immediate reward of your neighbor is so acute. Adopting a long-term horizon is a conscious and deliberate effort to override this faulty wiring. It is the act of training your prefrontal cortex, the logical, planning part of your brain, to overrule the impulsive, short-term desires of your limbic system. By constantly focusing on your 20 or 30-year goals, you shrink the perceived value of short-term speculative noise. You are, in effect, performing cognitive therapy on yourself, rewiring your brain to derive more satisfaction from the steady execution of a long-term plan than from the fleeting sugar high of a short-term gamble. This is the essence of mature investor psychology. To turn this concept into a practical mental model, we can use a powerful exercise called the compounding test. This is a quick calculation you can run anytime you feel the pull of envy towards a speculative asset. It's designed to replace the emotional narrative of getting rich quick with the cold, hard logic of mathematics. Here's how it works. First, take your current long-term investment plan. Let's say your plan is to invest in a low-cost index fund with an expected average annual return of 8%. Project the value of your portfolio forward 20 years using this realistic return. The numbers will be impressive, a testament to the power of steady compounding. Now take the speculative asset you are feeling envious about. Let's say it's a new cryptocurrency that enthusiasts claim could go up 10x in a year. The emotional part of your brain is captivated by this 10x number. But now, we apply the rational part. You must assign a realistic probability to this outcome. What is the actual chance of this specific unproven asset being the next Bitcoin versus the thousands that have gone to zero? Let's be generous and say there's a 10% chance it produces a spectacular return and a 90% chance it loses most or all of its value over the long run. Now you model this. You create a weighted average projection. You take the massive potential gain and multiply it by its low probability, and you take the massive potential loss, e.g., minus 90%, and multiply it by its high probability. When you do the math, the expected return of the speculative gamble is almost always dramatically lower than the steady, reliable 8% from your boring index fund. It might even be negative. This simple exercise does something magical. It takes the seductive, singular narrative of "what if it goes to the moon?" and replaces it with a more statistically accurate picture of the range of possible outcomes. It forces you to confront the high likelihood of catastrophic loss that your envious brain was conveniently ignoring. Performing the compounding test every time you feel FOMO is like having a pocket-sized financial advisor that splashes cold water on your emotions. It builds the rational investing habit of evaluating opportunities, not by their best-case scenario, but by their probability-weighted expected return, a hallmark of all professional capital allocation and a powerful shield against speculative manias. The antithesis of the long game is the all-too-common lottery ticket mindset. This is the investor who is not engaged in a process of wealth accumulation, but in a constant, frantic search for the next winning ticket. Their portfolio is not a curated collection of assets. It's a graveyard of yesterday's fads. Let's imagine an investor named Mike. In 2017, Mike got swept up in the first great crypto bubble. He bought Bitcoin and Ethereum near the peak, driven by stories of overnight millionaires. When the market crashed in 2018, he sold in a panic, locking in huge losses. Then, in 2020, he heard about the boom in electric vehicle stocks. He piled into speculative EV startups with no revenue, convinced he had found the next Tesla. A year later, most of those stocks had collapsed. In 2021, it was meme stocks. Then it was NFTs. Now it's something related to artificial intelligence. Mike is not an investor, he is a trend chaser. His strategy is to identify what has just gone up the most and buy it, hoping the momentum continues. This is the definition of buying high. He has no consistent philosophy, no long-term plan. He is perpetually drawn to the party that is already roaring, arriving just in time for the police to show up. The driving force behind his behavior is envy. He cannot stand to be on the sidelines while someone, somewhere, is getting rich on the latest craze. His portfolio reflects this. It has no core, no foundation. It's a chaotic churn of assets, each held for a few months before being discarded for the next shiny object. He never stays with any investment long enough to benefit from true business growth or the power of compounding dividends. His wealth management strategy is a series of sprints, with each one ending in exhaustion and loss. He is so focused on finding the 10-bagger that will make him rich overnight that he has completely missed the fact that the slow, steady path of owning great businesses for a long time is the most reliable way to build a fortune. The direct financial connection between committing to the long game and building massive wealth is the mathematical certainty of compounding. Albert Einstein supposedly called compound interest the eighth wonder of the world, and for good reason. Its power is subtle in the short term but overwhelming in the long term. Let's end with a definitive, side-by-side numerical comparison. We have two investors, both starting with $100,000. Investor A, our long-game investor, puts her money into a diversified portfolio designed to earn a steady, unspectacular 9% per year. She does nothing else. She just lets it sit and compound. Investor B, our lottery ticket investor, is driven by envy and chases trends. His returns are chaotic. In year 1, he gets lucky with a meme stock and makes 50%. His portfolio jumps to $150,000. He feels like a king. In year 2, the fad collapses and he loses 40%. His portfolio drops to $90,000. In year 3, he catches a small upswing and makes 20%, bringing him to $108,000. In year 4, he gets distracted by a new craze, churns his account, and ends up flat. His average annual return over these 4 years is technically positive, but the volatility has been a killer. Now let's look at Investor A. At the end of year 1, her 9% gain brings her to $109,000, far behind Investor B. She feels the sting of envy. At the end of year 2, she's at $118,810. Year 3, $129,503. Year 4, $141,158. She has already, with her boring strategy, surpassed the volatile gains of the trend chaser. But the real magic happens over decades. After 30 years, Investor B, with his chaotic, envy-driven strategy, might have gotten lucky and grown his account to $500,000. He might also have blown up and have nothing. But let's be generous. What about Investor A? Her initial $100,000, compounding uninterrupted at 9% per year for 30 years, will have grown to over $1.3 million. The difference is not just large, it is life-changing. It is the difference between a comfortable nest egg and true financial freedom. This is the ultimate financial payoff of mastering your emotions. The long game, protected from the poison of envy, is not just a safer path, it is a more profitable one. The quiet, relentless, upward-sloping line of the patient compounder will always, over a long enough time horizon, leave the jagged, chaotic path of the emotional gambler in the dust. That is the final promise of this philosophy. So let's take a step back and appreciate the powerful mental tool you have just acquired. You have not just learned a tip or a trick. You have absorbed a comprehensive framework for insulating your financial life from one of its greatest threats, the destructive power of envy. You understand now that watching your neighbor get rich on a speculative asset is not a signal to change your strategy. It is a test of your discipline. You have the circle of competence to keep you playing your own game. You have the inner scorecard to judge yourself by your own metrics. You have the allegory of Mr. Market to turn public panic into personal opportunity. You have a deep-seated respect for the poison of leverage. And you have the mathematical certainty of the long game as your anchor. This is more than just an investment philosophy. It is a system for achieving peace of mind in a world of financial chaos. But it is crucial to understand that what we have built today is a single, powerful fortress in a much larger, interconnected network of mental models. Warren Buffett's success is not the result of one great idea, but of a latticework of interlocking principles that support and reinforce one another. The emotional discipline we've discussed is the foundation, but it is made infinitely more powerful when combined with the specific techniques he uses for valuing a business, assessing management quality, and understanding competitive advantages. You have mastered a critical piece of the map, but the map itself is vast. You've built the engine, but there are other components needed to make the vehicle truly unstoppable. The video that is now appearing on your screen is not a random suggestion, it is the next piece of that map. It is the link that connects the emotional discipline you've just forged with the analytical tools required to act on it. Think of it as the next chapter in your education, the part that shows you what to do with the clarity and rationality you have now cultivated. The journey to becoming a truly sophisticated, self-directed investor is a process of assembling this complete mental arsenal, piece by piece. Others may be content with surface-level tips and hot stock picks. But you have demonstrated by watching this far that you are not like them. You are part of the small minority that seeks to understand the underlying principles of success. The choice to click is not about watching another video. It is a declaration of your intent to continue that ascent, to complete your arsenal, and to master the entire framework that has made Warren Buffett the most successful investor in history. Complete the map. The next piece of your journey is waiting.